Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, October 30, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So we had a big rally on our hands today. Markets are still wild. Markets are still a little bit crazy. However, the same theme applies. We're looking for a low. Was it put in yesterday? It's possible. Before we get into the details and uncover and unpack everything that I'm looking at, let me first thank everybody once again for participating, posting comments underneath the video. It's important. I love the interaction. Please keep up the great work. In addition, please hit the like button on the video and share the video with anybody that you think can benefit from this information. Let's go back to what I was originally looking at or looking for from a picture-perfect scenario. What I was looking for is a gap down, kind of a flush lower, an opening of the trapdoor, let everybody just throw up, and then have some kind of a reversal, whether it's intraday or a gap up the next day. That would suffice, and that's the way I envisioned us putting in a bottom. Is that still on the table? Sure it is. However, today's up day and strong finish is certainly important. This also speaks to the reason why I began collecting some equities. I began collecting shares in stocks. I began collecting some option contracts on some stocks. Not everything is going to rotate at the exact same time. So for example, and we'll get to this in a moment, I'm going to jump around a little bit. The IWM was a leading indicator today. It was up from the get-go. Not to mention the transports, the financials. So there were some clues out there that we were in store for a healthy up day. Let's just reiterate, just in case, a couple of things that I think remain important. I think tomorrow's an important day. We were discussing the fact that midweek was going to be important. Could it have come in early, and could we begin the rally from here and from yesterday's low? Absolutely. Remember, we were looking for a low. Remember, the 261.73 was put on the chart quite a long time ago. So we've obviously satisfied the downside targets. That doesn't mean we can't go lower, but I don't think we have a lot lower to go, even if we were to go lower. So everything remains the same from the downside perspective. How much lower? Here's the weekly chart. Nothing has changed. We would really find support if we were to begin going through a trapdoor to the downside at 255, 255 and a half, in that neighborhood, a bit of a spike through the 100-period moving average. Before we move on, a little bit of an intermission from Facebook. Facebook reported earnings after the close today. It's up slightly. It could be, and has been already, all over the place. So who knows where it's going to open up tomorrow. But certainly, if we're going to continue getting a lift higher, we could use some help from Facebook. Remember the 141 that I gave you over the weekend? We're now trading at about 146. Back to the spiders, and we'll close the book on the spiders. Again, we didn't get the gap down, and we also didn't get the volume. We never got capitulation volume. We didn't get volume surpassing the volume that existed right here on the 11th of October. So we didn't get capitulation. Does it have to happen? Well, I would like it to happen, but the market certainly isn't going to do what I like. It's going to do what it's going to do. And so we could have a bottom, but again, based on price, we wouldn't have been that far away, even if we have to go lower either way. Before we really close the book on the spider, let me go to the hourly chart and just show you where the next potential level of resistance, or I really should say natural area of resistance, will be from an hourly chart perspective. And it's the same price level that can be seen on the daily chart, but basically it's right here. And you can see that it would be a spike through the 50-period moving average on the hourly chart, takes us up to about 270, probably spike through it by a little bit, but we should find good resistance up in that neighborhood. When you go back to the daily chart, you can see that yesterday's high comes in at 270 and a quarter. That's going to be a very, very good level of resistance, at least from an intraday perspective. Closing hourly above that price level will be important and will likely promote higher prices if and when that does happen. The IWM, my favorite market leading indicator, we were up about 2.25% today. That's against 1.5% for the spiders. That's a big up day. It was up from the get-go. It was a leading indicator, and that's why it is my favorite market leading indicator in either direction, up or down. Taking a look over at the VIX, since we've been looking at it recently, we can see that the VIX was down about 5%, but it certainly wasn't down commensurate with the amount of points that the market was up today. So we have to still be on guard. Technically speaking, this is still a bullish chart in an uptrend. If the SPY is going to go up to the levels that we just discussed as resistance, likely the VIX would be coming down at the same time. Here is my second favorite market leading indicator, and I think there's a clue on this chart. It's certainly a puzzle piece, and I believe it's an important puzzle piece. So yesterday's high was closed above today. That's basically the bottom line. A tremendous day, almost 3% higher in the transports. Again, the reason why it's my second favorite market leading indicator. I believe this could be a potential canary in the coal mine. So closing above yesterday's high was important. We did it by a few points. That's not an accident, and it's not a coincidence. The next major hurdle for the transports is going to be about 10,300, right up in this zone right here. We're going to most likely rally up to that area. It will, at the first run, be resistance for the market. There will be overhead resistance for the transports at that area. Here's a chart of the Qs. You can see here it was a very strong update for the Qs, almost 2%. When you look at the NASDAQ composite, it was up about 1.6%. Some of this includes a little bit of the aftermarket activity. I just checked back on Facebook, and Facebook is up now about $6.50 from where we closed the day. Pardon me, that's from where we opened the day, but currently trading around 149. So that should be positive for the NASDAQ market tomorrow if it holds. That's an if it holds. Nevertheless, checking back with the Qs, you can see we have a long way to go to fix and do the repair job required in the Qs to really get going if this market's going to rally. So we're going to have to challenge, we're going to have to go up and challenge the breakdown candle high, and there's really nothing in between other than this 166.55 that may remain important once again. However, I'm not using that as a legitimate area of overhead resistance. What I am looking at is the breakdown candle high. And when markets are this kind of volatile, what you have to do is play what I like to refer to as the outsides. So you want to play the extremes. If you're in the middle of a range, it's very difficult. You really don't know exactly which way the market's going to go next in the middle of a range. But when you play an extreme, what you do is you get closer to the extreme level, you get closer to risk because you get closer to resistance or get closer to support. So you allow yourself to lose small and fast if you have to lose at all, and that's the objective. The objective is to make money, but if we're going to have to lose, it is to lose small and fast. But you all knew what I meant. How about the financials today? So we had some tremendous day in the XBD, up over $5, over 2%. Now, obviously, we've been hammered down severely in the XBD, but you can see here, it's the same routine that we just discussed in the transports. We closed above yesterday's high. I think that's important. I have to take that information seriously. Therefore, it's a puzzle piece. It's on the table. They did it by a few pennies. It's not an accident or a coincidence. I think that's a hint. It's a clue. It's a piece of evidence as far as I'm concerned. Speaking of clues and evidence, I'm jumping back around, but I think it's important that we discuss this. We're back on the spider, and we're at the intraday 10-minute chart. The question is, where exactly did you know that the market was likely to be bullish into the close? And here's my answer to that. It's not a definitive answer, and it's not going to work 100% of the time. But what I can tell you is that once we closed above here, right, this candle high was at 265.58. Once we closed above that breakdown candle, because we were making a bearish wedge pattern that would normally have sent the market lower to play out to the downside. Well, that same energy was then released to the upside, and what happened was we traded higher into the end of the day, finishing strong. That's bullish behavior, but that's the tip-off on when I believed that we were going to have a strong finish into the end of the day. Once we closed above that breakdown candle high on the intraday 10-minute chart. Now we're on the hourly chart, and here's the confirmation. When we closed above, let me show you the candle. When we closed above this candle, which had a high of 265.96 on the hourly chart, that was it. And then you can see here that the market really did take off. So the close was well above that, but you can see here that we were pushing higher, and then that 10-minute close was the tip-off, and that was an enabler to get on board to the long side with any close below that price level, and you would have had to move out of the long trade. It would have been a higher risk trade hopping on to a market that was moving higher with the type of volatility we've had. That certainly is the case, but I'm just telling you how it draws out and what it looks like. And if you see the same type of setup in a market that's not so volatile, you can take that trade with a lower risk, with lower volatility, but the same type of chart setup would apply. And that's the reason why I wanted to point it out. Back to the financials, here's the XLF, and here's an interesting one. Here's another no accident, no coincidence. Yesterday's high was $25.93. You can see it here, $25.93. Today's close, $25.92, did not close above yesterday's high. Again, it's not an accident or a coincidence. One market does, the other doesn't. I think it's cute, if nothing else. But it was still a bullish day for the financials across the board. That's bullish behavior. This is how the market's putting in a bottom. This is the process. I've been talking about a process for about a week and a half now. This is the process. Could we go back down tomorrow? Of course we could, but this is the process. This is how it happens. Money rotates around. It moves very, very quickly. And if you're listening to the media, they will drive you absolutely bananas. You'll never be able to get into a winning trade. Here's another canary in the coal mine, the SMH. We closed above yesterday's high by quite a bit. We finished right at the highs of the day. The SMH, or the Philadelphia Semiconductor Index, is a wonderful proxy for the tech sector. You have to like, from the bullish perspective, the SMH finishing at the highs of the day. Very, very bullish behavior. We've got some time left, so I want to talk about some stocks. And I want to talk about Amazon, but I want to talk about the levels from today. I want to talk about the bigger picture. I want to talk a little about sentiment. When I look at this daily chart, I can't help but remember and realize and point out to you guys, you folks, men and women, my apologies. I want you to remember, and even if you have to go back and look at news articles, here's when that occurred. It was on the 4th of September. So go back and look at news articles from about a couple of weeks leading up to and right through the 4th of September and see how the sentiment was for Amazon. What type of prices were the analysts calling for on Amazon? It was higher, 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 and that was indicative of what an extreme looks like. Now, the problem is you never really know exactly where the top will come in. But remember, we had trillion-dollar market cap discussions. We had it on two stocks. We had $2,000 a share. We had $1,000 a share on another stock. The media was giddy. Remember that, because they're wrong about 100% of the time. How bearish have they been over the last few days? Now, we may or may not have a low in yet, and you know the stuff that I'm talking about, so nothing's changed. But think in terms of how bearish they were, and now look back and think in terms of how bullish they were on the market and on Amazon at the highs. Now think in terms of how money is really made in the market. Apple, nice decent up day in Apple today, but again, you can't get any information on this chart other than it was up a little bit today. There's no real significant difference in the chart of Apple. Checking in over at Facebook, might as well look at the 10-minute chart just for fun. Nothing more, nothing less. You can see here we went down, we went up, and here we are pushing at $150 a share in Facebook. If it stays up this way, it should bode well for the NASDAQ market tomorrow. Netflix, the makings of a reversal today. We'll see if it holds. We're close, folks. Whether this was it or not, we're close. Google, same looking chart. Everything pretty much looks the same. Going over to Baidu, for example, again, you can't get any information from this chart. It looks kind of sloppy down here, but it was still up on the day. Alibaba was up about $4.50 on the day. Again, a lot of work to do to repair some of the damage, but it's a beaten down stock. Eventually, you're going to get a snapback. If we're right in where and when this market bottom is, everything's going to be like a rising tide lifting all the boats. Here's Cena was flat on the day. Again, rumbling down here at the lows, not out of the woods by any stretch whatsoever. How about GE? How about a washout in GE down another 9% today? Getting through the all-important $10 big, fat, juicy round number. This is a fall from grace. When you look at the monthly chart of General Electric, what was this? And where else have we seen this before? This was a big, huge down move, a bearish wedge pattern, and another big down move. This is a monthly chart. This was years in the making. This began at the top in 2007, and this chart is basically telling us, and not that you can't get some kind of a rally from here. We likely will. Even up to in the mid-teens is likely to happen at some point over the next year, for example. But what this chart is telling us is that what's likely to happen is GE will not exist in its current form at some point in the future, but that is years into the future. Just look at the chart of Sears, and it's a similar model. It's hard to believe, it's sad, but it is what it is. Energy is a big component of the S&P, for example. How did energy do today? Here's a representation in the XLE, trying to put in a reversal. So basically, all charts look similar or the same as each other. Tomorrow will be an important day. It's an important day, number one, and it's an important day to see if we get follow through. If we don't get follow through and this fails, then we may not have seen the bottom just yet. One day at a time, one candlestick at a time. Remember gold, and we discussed the fact that if the fear trade was still on, wouldn't gold be higher by now? And I think that to be the case, and I think that supports everything else that we've been discussing tonight. So therefore, I'm not necessarily interested to be long gold, even though it is a bullish pattern. But we know the story with these bull flag patterns. They have a high risk reward scenario. They play out a lot of the time, but they can also go all the way down to the low of the breakup candle. It's no longer a bull flag pattern, but it still keeps the bullish pattern intact. I don't want to be there between now and the low of the breakup candle, so I'll just leave it alone. Crude oil, we started to come out of this bearish pattern today, but they fought their way back to get above or back above the 200 period moving average. But it's weak and it looks like it wants to go lower. I would say the direction is likely down. Very hard to sell in the hole. It's already down a lot. If this 200 period moving average holds and this energy is released in the other direction, we'll immediately go to test the top of the breakdown candle, which comes in at 69.66. So you almost can't be short right here because of that risk in and of itself. And with that, folks, I'm going to cut it short tonight and give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.